I think we're in a concentration bubble. Japan has been the world's bank. It's been the source of leverage for a lot of dynamics globally. I'd argue a lot of money has gone into NVIDIA and the AI trade because it's been funded by the carry trade. It's not about NVIDIA, it's about Japan. People are starting to come around to the fact that, yes, Japan is a big source of liquidity for worldwide risk-seeking behavior. You're going to get intervention, it's not going to work. You're going to get intervention, it's not going to work. Right? At some point, the free market will probably push the yen even lower, and that's going to be a real problem longer term from Japan, but they're going to try and prevent it along the way, and that means you're going to get these deleveraging pulses along the way.
Michael Gayed is back. He's a portfolio manager of the Free Markets ETF, publisher of the Lead Leg Report, and today we're talking about Japanese bonds and how they're impacting global treasuries and global markets overall. Welcome back to the show. Michael, you've been calling for this scenario for quite some time. We had this discussion last August when it first started to catch mainstream attention. Yep. It's starting to reaccelerate and populate on mainstream media once again. So good to have you back to talk about this issue. Let's flip over to my screen right now. This came in yesterday from, I'll just read you two sources, one from Bloomberg. Treasury started the post-Thanksgiving week on the back foot as a slide in Japanese debt spilled over into bond markets globally. The yield in U.S. 10-year notes rose 3 basis points to 4.04% following a jump in the Japanese equivalent to the highest since 2008 on the prospect of a Bank of Japan interest rate hike later this month. That also pushed up rates on bonds from Europe to New Zealand. So globally, treasuries were affected. So we have here a situation that you've been talking about for a while, the unwinding of the yen carry trade. Tell us more about this.
Yeah, since August 2023, and I first brought it up on your show, by the way, when I was quite a bit heavier. I'm sure you're going to pull that clip up, and the funny clip of me saying what I thought would be the end result, which I made a whole thread on X as far as how I think this whole Japan scenario plays out.
Scrolling through your Twitter, I think you were trying to highlight the importance of the yen carry trade. You highlighted a paragraph from an IMF article, and the abstract reads, the financial press at the time, I think you were talking about the 2009-2008 credit crisis, referred to a collective margin call on the United States in which foreign creditors sought to reduce their exposure to the deteriorating creditworthiness of U.S. borrowers. This paper argues that the carry trade should instead be viewed in the broader context of global credit conditions. What does all this mean?
It means we're all I don't know how else to say it. It's like, no, but really, it's. I'm making light of it because I think it's funny, legitimately, and I think you have to have humor in the face of what could be a crisis that nobody can really fully control, just try to manage through, right? So to your point, it played out for a moment in time, August 3rd, August 5th last year, and then everyone forgot about it. I will say the fact that you just said that it's got mainstream attention now probably means it's not going to happen right now, but who knows? But the reason it does matter is because Japan holds a lot of U.S. treasuries, right? And as the yen weakens, the problem with the yen weakening is that Japan imports all of its oil, which is denominated in U.S. dollars, which means that if the yen weakens, then oil priced in yen is actually rising, right? Even though it might be falling in the U.S., depending on what time frame you're looking at, it's rising for Japan. And that's a problem for a country that's entirely dependent upon importing oil for its energy needs. So clearly, Japan's bond market is very worried about the fiscal situation and is very worried that the Bank of Japan is wildly behind the times, which they are. That was part of the thesis, that they were the last to really recognize inflationary pressures worldwide would at some point impact Japan itself. Now, there's been a lot of talk, and I think there's some truth to it, that some of this pressure, very short term, we've seen in long duration treasuries is because Japan is probably selling some of their treasuries. Why would they do that? Because they have to raise dollars in order to support the yen. They have to actually have dollars to then, buy the yen, sell those dollars. So I suspect we're going to see more of these sort of scares in the treasury market. Independent of whatever the Fed does, I think an overwhelming burst of supply periodically from Japan will counter any hopes of stimulative actions from the Fed, because the Fed may be lowering rates, but the Bank of Japan is raising them by putting more supply of treasuries into the open market. At some point, that will manifest into some kind of credit risk. I don't know when. It looked like it was going to be there again, August 3rd, August 5th last year, but it's out there. I mean, the carry trade is not done. If anything, it's more profitable than ever. And at some point, that leverage will turn into deleveraging.
The unwinding of the yen carry trade, basically goes like this. Traditionally, investors borrowed yen because the rates were low and then invested the proceeds in higher yielding foreign assets, foreign being US, potentially Europe. Now that's starting to change as the Japanese 10-year has risen to above 2008 levels. And in fact, it's rising faster than ever. So we have here a situation where now investors are borrowing in foreign assets and investing in yen potentially, or yen assets. Right. That could mean a sell-off in foreign assets like treasuries, like stocks, as people move assets into Japan. I don't know if that's been contributing to volatility this month, but certainly that happened back in August. So tell us more about that.
Yeah, in August of last year. And part of the thesis that I've had now for 2 years, and I've been wrong, and people will say, wrong, and early, or, there's a fine line between early and wrong, and you've been wrong, your timing's been off. Okay, sure, I've already talked about that, admitted that. I still believe that this is a real risk that's out there, but the timing is the tricky part, obviously. The issue fundamentally is that Japan has been the world's bank, right? It's been the source of leverage for a lot of dynamics globally. I'd argue a lot of money has gone into NVIDIA and the AI trade because it's been funded by the carry trade. So what happens when I even put a post out on X saying, when you had that sell-off in November with NVIDIA, I said it's not about NVIDIA, it's about Japan. And it got a lot of engagement because people are starting to come around to the fact that, yes, Japan is a big source of liquidity for worldwide risk-seeking behavior. So if the Bank of Japan finally does panic, which is something I've been posting nonstop, and I've been wrong. They have not panicked yet. But if they panic, meaning they're going to step in aggressively to try to support the yen and prevent further depreciation there, that's going to cause a selling of the assets that the leverage has been deployed into, whether it's stocks in the U.S. or treasuries or anything else. And part of the original thesis was that part of that panic meant that yields would rise on treasuries as they sell treasuries. Japan sells treasuries. But that at some point that spike in yield reverses and you get back to the sort of more classic risk-off flight to safety as stocks keep falling, right? So it's kind of a two-phase sort of sequence, I think, that this plays out with. Again, the fact that people are talking about it makes me think it's not going to happen right here, right now. I mean, that's just me being contrarian. But, and I don't think it's, by the way, just sort of one dynamic, one event. Like, you're probably going to have multiple of these pulses from a reverse carry trade happening over the next several years, because you're going to get intervention, it's not going to work. You're going to get intervention, it's not going to work. Right? At some point, the free market will probably push the yen even lower, and that's going to be a real problem longer term from Japan, but they're going to try and prevent it along the way, and that means you're going to get these deleveraging pulses along the way.
Gold is one of the best assets of this year, and you already know why people hold gold. Well, it's because it's real money. But what if your gold could do more than just sit in a vault? That's where today's sponsor, Monetary Metals, comes in. They offer a way for you to earn yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your bullion can now work for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn monthly interest in gold and silver through Monetary Metals, so don't just hold it, put it to work. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and get started. I have here a chart of the US dollar versus Japanese yen. We can talk about why the US dollar has been strengthening despite the Japanese 10-year rising. But if you just overlay that series with the NASDAQ, which is now the blue line, you can see a pretty close correlation. I think I brought this up to you last August when we spoke about this as well. And it hasn't really broken throughout this year. And in fact, it's probably just strengthened. So I wonder why this relationship even exists.
Well, it exists because if think about it, if you're sitting in Japan and you're seeing your savings are getting depleted because of inflation, which the Bank of Japan is not going after, what are you going to do? You're going to take risk. All right. So what are you going to do to take risk? You're going to invest outside of Japan. Well, where are you going to invest? There's this really big stock called NVIDIA. There's this really big theme called AI. And there's plenty of evidence that suggests that Japan, a lot of retail on the Japan side of investing has gone into those names. So like the truth is, yes, it's a real theme. I get it. And yes, AI is here to stay. And yes, there's a lot of earnings power, but there's been this added sort of tailwind of money, not just from retail in the US, but retail, I'd argue, especially from Japan, wanting to get out of the yen and deploy it elsewhere because you're not going to make enough money sitting in Japan as they keep on depreciating the yen the way they are.
So what's your outlook for what the Bank of Japan is going to do? Ultimately, what the 10-year yield in Japan is going to do, and how that's going to impact the rest of the markets?
I mean, I think the real question is, are you going to see what you saw with the UK? Whatever it was, I think 2 years ago with the gilts, where you had this sort of blow up suddenly on yield spiking, the Liz Truss moment, so to speak. I think there's a distinct possibility that happens, right? Because every time I look at the chart on Japan's yields, it's like another new high, another new high, another new high. Every single day, it seems like there's another X account that's saying another new high. So at some point, it becomes really problematic. Now, I don't know what level, right? I mean, for all we know, maybe they have to go to 5%, which would be cataclysmic, right? I mean, I don't know if people really understand that Japan's banking system is probably insolvent because they have safe collateral, which is what? JGBs. Well, it's not that safe if it keeps selling off because yields keep rising, right? So again, it is a lurking condition in the background. How you execute on it is a totally different story. It's not like one of those things where you say, okay, well, I'm going to short to play this. Maybe you have some puts that have some kind of expiration that are long dated, because I think this could take some time. But all it means is you got to be careful because, at any moment you could wake up and suddenly the Nikkei is down 10%, like it was August 5th, right, intraday. And suddenly everything gets taken down with it.
Well, some people are talking about the interest rate disparity being a problem and perhaps a trigger for a further market sell-off. So we have here a situation where the Bank of Japan is raising rates and the Federal Reserve is lowering rates. And so that interest rate differential is going to push assets into Japan, triggering a further sell-off in the US. This has been the thesis of your outlook for quite some time, although it's happening now and people are talking about it. I don't know if they're parenting you. I'm just saying people are talking about it. So
I like to think that imitation is the greatest form of flattery. But now, by the way, just to be clear, I'm not a doomer by any means. I mean, I have risk on, risk off funds. I have the free markets ETF, which is a longer term theme around deregulation, FMKT, because I do believe that's a bullish tailwind for the US. But in a bullish environment, you can have tail risk. You can have extremes happen. And my entire thesis has been, at some point, there's some kind of extreme that's going to come from Japan. Some people will say, I can't do anything with that information. You know what? You're right. But it's just about managing expectations. The risk is there. And the fact that people are talking about it maybe makes the risk not there for a moment in time. But there is a lot of leverage that has come from Japan. You can't deny that there's still a possibility there's a deleveraging event coming from that country's currency movement.
Okay. Well, that aside then, major market movers going into the new year. It could be this, it could be something else. What are you watching?
It's going to be interesting. I think, I do think the healthcare relative momentum is real. And speaking about deregulation, I think there's going to be a lot more deregulation coming on the healthcare space, which should benefit the sector because it's been left for dead for a long time, especially the biotech space, for sure. I mean, you can't have this, what do they call it, Project Genesis, Mission Genesis, whatever that Trump signed on AI without having AI integrate into health, right? I mean, like, of course, it's not just going to be chatbots. It's going to be, surgeries and medicines and all that stuff. So I think you're going to see some interesting deregulatory pushes there. So I think next year there's going to be the year for healthcare, personally. This still has been obviously an AI-driven, tech-driven type of environment. Healthcare may not be the sexiest of sectors, but it's the one that I think logically benefits the most from AI next. And it's very underinvested. So I think that's a big area to watch. I still think regional banks are going to be interesting. The counter to that is what happens with private credit. And I've been flagging the risks of private credit for some time. I've said private credit is this cycle's subprime, not to sound like it's going to be systemic. It could be systemic, but I'd say like that's relatively low probability. But there's a bullish case for regional banks, but the counter to that is the private credit risks, which I think are out there. And then aside from that, like at some point in my lifetime, small caps will work. I don't know when. If I live long enough, small caps will start outperforming maybe. But there should be some broadening at some point that that should be taken advantage of, I think, by investors. I don't know if people really get it. like we've had a bull market when you look at the S&P and the NASDAQ, obviously, but the majority of stocks are still, especially after inflation, below their 2021 highs because the majority of stocks are small cap.
I see. Well, we can look at liquidity as an indicator for market performance. You've often talked about how liquidity drives everything in your work. So maybe we can link global liquidity situations to the yen discussion that we just had, whether or not the reversal of the yen carry trade will drain global liquidity outside Japan, or can we see liquidity draining from just other sources?
Yes, but I mean, I think the Fed just ended quantitative tightening. So I'm sure they're seeing that liquidity might be strained a bit with Japan, right? It's funny timing, right, for this all to happen with the Fed, stopping tightening the QT side. So yeah, I think liquidity, and who knows with Trump if we're going to get these supposed tariff stimulus checks, that's going to be liquidity also, right? Given to those, I think it's floated that it's for those that are making less than 150K, they'll get that stimulus check from all the tariffs. So there's going to be liquidity can be seen by the policymakers and can be somewhat countered, right, for a moment in time. So I suspect you're still going to have more liquidity despite the inflationary pressure.
One thing I noticed is that, well, like I said, the Treasuries sold off, U.S. Treasuries sold off, even as Japanese bonds sold off.
Yeah.
Does that question or challenge the thesis that U.S. Treasuries are a flight to safety, or is this just a mechanical sell-off that stems from capital flows from Japan into the U.S.?
Probably more mechanical, but the truth is nobody thinks treasuries are a flight to safety trade anymore except me. It's like, and I say that because I'm biased. I have two funds that are designed by prospectus to use treasuries as the risk-off flight to safety whenever credit spreads eventually do widen, which at some point is going to happen. I've been dead wrong on the timing of that, but at some point it's going to happen. Look, the reality is a lot of the scared money has gone into gold. Has gone into silver. Silver's gone parabolic now. That's not scared money. That's probably just short squeeze, right? That's taken place. Precious metals in general have been the flight to safety trade, and now the speculative momentum trade. At some point, though, as I keep saying, treasuries will stand alone. I've been dead wrong on my timing. I admit it. People are like, "Oh, you've been wrong." It's like, yeah, I know. I've said I'm wrong, right? But at some point, credit risk is going to matter. I don't know when.
Do you think credit spreads will widen soon?
The thesis all along with Japan was that will be the spark for credit spreads widening, right? Because if you have the reverse carry trade, then all that leverage that's coming from Japan comes out of the highly speculative parts of the market, which includes junk debt, right? Because the yield differential is highest there, right? So relative to JGBs. So that forced selling from the reverse carry trade would cause junk debt to sell off, which would cause widening spreads, which would then have the flight to safety dynamic, which has been lacking this whole time because there's no credit risk in U.S. Treasuries, believe it or not, despite what people say, at least for now. So I still think that that's a possibility. Like nothing has changed in my thesis. I feel like the broken clock, and people are like, oh, broken clock's right twice a day. Sure, but that 1 minute can define the day if I'm right. All right. So again, how you act on it is a totally different story, but it is something to keep in the back of one's mind. Markets have a funny way of erasing months of gains in a week. Like I feel like too many people have forgotten entirely that there is kurtosis. It's not a normal distribution when it comes to the way the stock market behaves. And again, I don't want to necessarily see it because I have a long only ETF, free markets, FMKT, that just long only. That's a big theme. It'll be a buying opportunity if that's the case. But Japan is still a big deal, and I think it's worth paying attention to.
So you've often said that, this could be the trigger for a bigger event. But what are the indicators you're looking for that this is a actual trigger for a bigger volatility unwinding? So are you looking at utilities versus cyclicals? Are you looking at the lumber to gold ratio? Are you looking at credit spreads like we just talked about? What are you looking at to facilitate the view that this is now a full-blown volatility event?
Yeah, I mean, the big thing would be credit spreads, which again goes back to junk debt. Like that's what needs to break. Even in the midst of the tariff tantrum, there was a massive divergence between weakness in equities and weakness in high yield junk debt, which suggested that equities were wrong about tariffs and high yield was right. Right. So I think if you start to see junk debt really start to fall heavily as, rumors are out there that Japan is selling treasuries at the same time, that would be your signal that this could be it.
Generally speaking, how important is monetary policy divergence between the Bank of Japan, one of the biggest central banks in the world, and basically the rest of the world?
It's interesting. There's a lot of studies that suggest it's not as big of a deal as people think when you actually look at some of the historical data on it. I think it's all relative, right? Because the marginal seller is the person who sets the price, right? So even if the rates are not, super wide, and even if historically they're not as big of a driver as the narrative would have you believe, it still has an impact in a highly leveraged society.
Sure, but let's just take the Treasury yields in the U.S., for example. So how high do you think Treasury yields could go if, let's say, Japanese institutions continue to repatriate capital assets? Are we looking at 4.5%, 5% again?
Yeah, but you could break 5% for a moment in time. Sure, could be a panic. But again, that goes back to that would be sequence one, phase two. Then would be that would suddenly result in money going back into U.S. Treasuries as stocks keep falling at that. But which brings back the historical risk-off flight to safety behavior.
Would a sell-off in Treasuries, like a 5% 10-year yield for scenario, would that necessarily mean good news for stocks? Would that be a risk-on kind of play?
It's you can argue in the short term it can be seen that way because money will just simply keep selling out of bonds into stocks. Like it's just a rotation, right? Reallocation. But again, at some point that becomes a source of strain, which again would be seen in credit spreads, right? So it sounds like I'm saying all scenarios, but I'm really not. What I'm arguing is that it's about the timing of the way it plays out. The sequencing of returns. Well,
overall, U.S. markets and commodities have been doing quite well the last 2 days. So we're looking at a 7% jump in Bitcoin intraday just today. It's now up to above $90,000. It was all the way down to $80,000 a couple days ago. And then gold is up to $4,200. We have to talk about, just mention silver. It was nearing $60. It was 58. Let me just pull up exactly what it is now. 57.7. So it's about $58. So soared way past the $50 resistance line. And the S&P and NASDAQ continue to grind higher to new all-time highs. Markets are all basically reaching your four territories for all the assets I've mentioned, except Bitcoin. That's still underwater year to date. But the other things are just moving higher. What are they signaling? They're moving higher together. And I think that's kind of the key.
Yeah, it's everything's working except Treasuries, which makes you question what the contrarian trade is, I think. But look, I mean, I think in general, I think silver's a unique case because, we can debate this or not, but it seems like the people who a lot of other people thought were crazy, arguing that there was manipulation of silver prices, it seems like the conspiracy theorists might end up having the last laugh, right, with the way silver has kind of shot up higher.
What do they have to do with conspiracy theories?
Well, that the paper versus physical, that there's been suppression on purpose by banks and all the stuff that you see on Reddit and other places, right? It's like as I get older, the conspiracy theorists end up seemingly getting more and more right, which is that's a conversation for a whole other show. But look, everything bubbles have a funny way of continuing longer than you think, right? I mean, it's literally everything.
So what do you think is driving this pop in silver? Banks are unwinding their shorts? Is that what you're saying?
I think there's some element of that. I think there's just in general, it's a catch-up trade to gold, right? The gold-silver ratio obviously has been something people have talked about for a while. So there might be some mean reversion there. They call silver poor man's gold for a reason, right? Okay. So it's like, if gold keeps going up, then silver's kind of your late catch-up trade to that.
Well, let's talk about, let's finish off on the theme that you brought up earlier for the free markets ETF. So healthcare relative to AI. And before we talk about healthcare itself, I wonder what you think about the AI trade now and whether or not a bubble pop is going to dramatically throw you off your thesis here for healthcare.
Not necessarily, because healthcare again has been such a big laggard for so long. I just think it's underinvested. And healthcare tends to be more of a defensive play in a recession anyway, right? Obviously. So I think, if anything, if you're negative on equities, but you got to be long only, healthcare is probably a good place to consider. On the point about AI as a bubble or not, I've said it before. I think we're in a concentration bubble, which you can say is an AI bubble, but it's a question of weighting, right? Which goes back to my prior point that the majority of stocks beneath the market are still below their respective 2021 highs. The bubble is in the weighting structure of the market. Now, you can resolve that in one of two ways. Either the AI side, breaks and those weightings come down relative to everything else, or everything else plays catch up. Small caps hold the key. That thing I've been saying for 2 years, like a crazy person. Again, it seemingly hasn't mattered because the market keeps going up, but small caps still keep sucking wind. the bull case is, I think, very clear. You can have AI break, but suddenly every other company which should benefit from AI starts to have real momentum. And there's a lot of companies that are undervalued. A lot of companies that can have some big multi-bagger returns. But until the focus away from AI takes place, those companies are just going to keep on being ignored.
Okay, lumber to gold ratio. That's been basically, basically collapsing.
Yeah,
so
and has not been an indicator of risk off. I mean, let's face it. It's
the indicator's broken. You're not following that anymore.
No, I follow it unequivocally, but it's like, it matters only to the extent that housing is the business cycle. Well, it's very clear housing is not the business cycle now. AI is, right? So it's like, and that, by the way, took me some time to sort of come to my own realization of that. It's like, the whole idea of lumber is that it's selling housing, and housing is shown historically to be a big driver of economic growth and recession. Well, you see all the same stats I see, right? It's like, in the absence of AI, GDP would be almost flat, right? In the absence of anything that's gone on with AI, the economy would barely be growing. So, yeah, it's clearly not working for now until AI is no longer the only thing to focus on, and housing goes back to its prominent place as a big driver of wealth.
But now that the lumber to gold ratio has significantly fallen from its highs, can we make the conclusion or deduction that housing is going to follow that trend? In other words, a big housing correction. It's already happening in a lot of cities, like where I'm living in Vancouver, but I don't think it has to do with the lumber to gold ratio, maybe. But what do you think?
Yeah, I think, so I think the answer is yes. Now, the counter to that is whatever Trump does when it comes to 50-year mortgages, and Fannie Mae seems to now become conceivably a meme stock. We actually have Fannie Mae in the free markets ETF FMKT as a deregulation play. If there's government support on the housing side, that's going to slow down, I think, some of those concerns, right? But remains to be seen. I think even today, as we're talking, on December 2nd, Trump's going to have an announcement at 2:00. There's speculations around housing, Fannie Mae, who knows? But that would be the only, I think, counter to the argument that housing is going to break, it's very substantially.
All right. Well, overall then, what are you most bullish on right now?
Your show. I'm very bullish.
Can't invest in that.
Hit the subscribe button. I'm very bullish on the numbers. He's not paying me this year.
Please do, and please follow Michael as well. But yes, anything that is investable in the securities universe.
No, again, I think big picture wise, I think healthcare's, biotech in particular, is an interesting place to be. If I'm going to say individual stocks, Eli Lilly, because I think this retatrutide drug is going to be a big deal once that's released, the next sort of iteration of the GLP side of things. Fannie Mae gets to be interesting as an individual stock. Again, we have in the free markets ETF, FMKT. Like at some point, the cycles reassert, and it's not going to just be all about NVIDIA. So, I'd say anything outside of NVIDIA is worth paying attention to now. Okay, good. Thank you, Michael. Tell us where we can find you. Lead Lag Report on X, Lead Lag Media on YouTube, and of course, pretty much anywhere, because I am everywhere. All right, you are the deity of Twitter, so that's why you are. Is that what I am? Omniscient person on X. So please do. You haven't gotten a lot of flack recently on X. That I haven't seen you arguing with people recently. So I just don't give a damn anymore, man. I just don't. I'm like, the older I get, it's like, you know what? I heard this quote. It's like, why am I going to take advice or be pissed off about people whose lives I don't want to live? I think that was a Kanye West quote. I'm not sure. Probably something he'd say. Thank you very much, Michael. We'll put the links down below. I never thought we would end on Kanye West, so thank you for that. Follow Michael, and I don't know, maybe follow Kanye West. We'll see you next time. Thank you.